We'll get started, everyone, in about 1 minute. Our live webinar, first live webinar, Steve and I at Insurance and Estates and Focus Wealth Group.
That's right. Very exciting.
2022, we got to go live.
You got it. Glad to see you guys jumping on. It's exciting. Welcome.
Great. Well, Steve, it's the top of the hour. Love to be on time, and we'll see people continuing to jump into the webinar. So you want to kick us off, Steve, for our first live webinar?
You bet. Thanks, Barry.
You bet.
Really excited. Thank you guys all for joining us. We know from, kind of how we reached out to you that you're part of our I&E network, folks interested in high cash value life insurance, infinite banking, or whatever name, I guess, for the strategy suits you. And maybe you're new, or maybe you're pretty experienced with this strategy. Well, our goal today is to give you some new insight, perhaps. Maybe solidify some things that you're wondering about, answer some questions for you, and just really begin to, our goal this year in 22 is to begin to connect with you guys as a community. We really appreciate this strategy and this movement. It's a bit contrarian in many respects, and we've seen it do a lot of great things in many lives. So with that, let's kick off a little bit about Barry and I. We are partners in our shared expertise to share the power of high cash value whole life insurance. We both have a pretty strong history, a little bit of mileage behind us, I guess you'd say. I started out as a trust and estate planning attorney. Many of you may know that. I was inspired years ago by a colleague that was talking about utilizing what we call mutual whole life insurance in a different way, in a way that creates liquidity, that offers tax advantages, and offers an alternative to really a lot of the conventional ideas as far as investing. So with that, connected with our other partner, Jason Kenyon, who's, I believe, listening today. And we started Insurance and Estate Strategies, and shortly thereafter connected with Barry, who is an infinite banking practitioner and expert in his own right, having been helping folks with these strategies for many years. So Barry, you want to jump in a little bit about what the goal is for today?
Yeah, we're going to obviously discuss the top 5 benefits of high cash value whole life insurance. We're going to discover why there are criticisms of high cash value whole life, but a lot of those criticisms are based on misconceptions and misunderstandings. We really put a lot of educational content out there to clear up those misconceptions. So we'll go through some of that today. And then also we want to highlight key concepts and benefits for you that might be unknown about high cash value whole life insurance. It's called life insurance for a reason. It's not called death insurance. So we focus on these unknown benefits of how to use these policies throughout your life. And the benefits are multiple fold over and over. We won't have time to even get into all those today. We're going to hit the top 5, but you'll walk away from the webinar with a much better understanding. Now, before we get into it, housekeeping. We want to make sure that you're really paying attention. Stick with us to the end, because at the end, we're going to show you a way that you can learn more, even see your own numbers. So stick around to the end. We would encourage you to take notes, shut down Facebook. Don't be checking your email throughout this, because what you learn today literally could be life-changing. I hear from clients almost every week, Steve, Barry, I wish I would have known about this 20 years ago. I hear that over and over again. So all of you on the webinar today, you have the opportunity to learn about this now and take advantage of it so you don't have a regret 20 years from now saying, oh my gosh, I wish I would have done that 20 years ago. You can do it now.
Right.
So,
And Barry, let me jump in on that. We're starting to talk to different marketing people that we work with, consultants, and they're saying, hey, this is pretty awesome. I've never heard about it. People that we're crossing paths with because of, I think partially because of everything going on in the world, but also just people becoming more and more aware of how to utilize this asset. So really want to emphasize that for you guys.
And we are live. We're hoping everything goes well technically, but we are really live. So thank you for being with us. There are 5 sections we're going through today. At the end of each section, we're going to take 1 or 2 questions if they come through, and as they come through, we'll open it up for Q&A. So in your Zoom toolbar, you'll see, if you hover over that, a Q&A menu. If you click on that Q&A, if you have a question for us, go ahead and type it into the Q&A. We'll be monitoring those questions, and at the end of each section, we'll answer 1 or 2 questions. And then at the very end of the webinar, again, we're going to give you a call to action where you can learn more, look at your own numbers, so stick around to the end. We want to look first at social proof. Before we even get into the top 5 benefits of high cash value whole life, we want to look at social proof. And we do this, and we want to start off with a bang, because I hear often, Steve, and you have too, why haven't I ever heard about this? But it's actually more popular than people think. And if you do a little bit of research, you'll see that banks and corporations and wealthy people and business owners over and over and over are all using high cash value whole life. So what I like to point out, I'm going to go to the internet. We're going to go directly to the FDIC website. Okay, this is public information that there are banks using this strategy. So I've pulled up JP Morgan Chase. Okay, I'm not making this up. You can go look at this at yourself. And this is their balance sheet. And this balance sheet is in the billions. And if you scroll down here to line item number 41, notice it says life insurance assets, 12.1 billion in cash value life insurance. And you got to ask yourself, why does a bank have 12.1 billion in life insurance? Here's bank number 2. This is Wells Fargo. And we could go through 10 banks, 20 banks. They all do this. Wells Fargo, we go down to their life insurance assets, 19.4 billion, Steve. Isn't it amazing that the banks and financial institutions that are supposed to be teaching us about money don't teach us about this, but they themselves have high cash value life insurance? It's pretty remarkable.
It is. And I'll just comment on that for everybody real quick. I get clients on the estate planning side. And one of the questions that's popping up these days is, well, where do I put my money? So you guys just thinking about it, ask yourself, banks have the same ideas, right? At a larger scale, maybe, where do I put my money? Well, they want to put a portion of it in this asset for a number of reasons. They use it for different kinds of planning, but really what they're doing is they're parking cash in high cash value life insurance for a number of reasons. So, and we'll talk a little bit more about that. And we talk a lot about that in various webinars.
Yeah. And again, not only banks, but major corporations, universities, wealthy people that we've all heard of, like Walt Disney and Ray Kroc of McDonald's, and politicians, and even investors, Warren Buffett, Robert Kiyosaki. These people, these banks, these corporations are using high cash value whole life insurance.
Yeah, Jim Harbaugh was one that he actually major part of his compensation, right? And he's kind of in the news right now. If you're from Minnesota or anywhere near there, they were kind of hoping to grab him, but anyway, that's a side issue.
Yeah.
So,
And the question, why do they do it? Because they want a better growth rate. They want tax sheltered money. They want safe, guaranteed, predictable money. They want access to liquid cash. It's key person protection. So yes, the bank is the beneficiary of these policies, and they're insuring employees or key people or executives. And there's very high funding limits. We don't have the restrictions in these policies like you do in your 401k or an IRA or a Roth IRA. Very high funding limits in that regard. And then one last thing before we get to the top 5 benefits, I like to point out some pain. Okay, here's pain. And the pain I'm sharing, and let's just go live. Okay, let's look at this live in real time on the internet. You can go to US Debt Clock, and you can look at how much debt and many other things the US has. In the top left-hand corner, we're sitting on 30 trillion. Now we're talking trillion, Steve, with a T. 30 trillion that the US has recently surpassed in debt. And frankly, it's an astounding number. We can't even fathom how much money that is. But just the interest alone to pay for this debt is mounting, and the US is really struggling to even pay the interest.
it's gone up considerably since we started doing these webinars, Barry.
Yeah, I mean, just in the last 2 years with COVID, it's about $6 to $8 trillion. And I point this out because how does it get paid for? All of you out there, all of us, we're paying taxes. And ask yourself the question, are taxes going up or down in the future? Well, what I see is they're going up. And then the really kind of staggering number, if 30 trillion isn't staggering enough, is this number in the bottom left-hand corner, right-hand corner. US unfunded liabilities, 164 trillion of unfunded liabilities. What that means is the US is on the hook to pay out 164 trillion. Social Security, Medicare, Medicaid, and the 100 of other government entitlement programs. My point is, we're going to show you today how to grow money tax-free, how to create more wealth and have a better future. If you're creating tax-free buckets of money today, what I'm sharing with you on the screen isn't going to be as harmful. So take it seriously. You want tax-free buckets of money in your life. Any feedback on that, Steve?
Well, taxes is a big part of this strategy. We do write and speak a little bit about the conventional wisdom around 401k, IRA accounts, and these kinds of things. And there is a valid point to be made about, maybe you want to pay taxes on the seed rather than the harvest. And, the IRS well knows that, that pile is going to grow. Taxes are potentially likely going to go up. And so, you have to decide for yourself what makes the most sense. With the life insurance benefits that are available, you get tax advantage growth, tax-free growth in many respects. And so it's a way to sort of hedge against taxes going up. And it's an exciting part of the strategy.
Yeah, awesome. Well, Steve, let's dive into the top 5 benefits of high cash value whole life. If you want to kick us off, benefit.
Yeah, so benefit 1, this is a guarantee. I love this as an estate planner. One of the reasons I love doing these webinars and tag teaming with Barry is because I take everything from a planning perspective. Yes, it's, some say you shouldn't call life insurance an investment. The fact of the matter is it's a predictable return. Every policy has a predictable, guaranteed growth that's associated with that contract. And life insurance is a contract. Whole life insurance, particularly mutual whole life, the insurance company really has the risk there because they've got to provide you with that guaranteed growth. This is where people get lost in the weeds. Other kinds of life insurance actually shift the risk to the policyholder, even when you get into some of the index products and things like that. This is the one product that's got, basically the insurance company holding the bag in terms of risk, and they're going to guarantee a percentage return on your capital. And Barry's really good at demonstrating that, what that looks like with a particular person, particular age group over time. What does the guarantee look? And then based on the historic dividends, what will the non-guaranteed, and these policies, guys, are issued they're illustrated rather very conservatively. So we're not talking about taking a sort of a average return that's typically high and over a long period of time. What we're really talking about is just the guarantee. The way you're supposed to illustrate these is really showing the guaranteed and then the non-guaranteed based on dividends. So and dividend history, a dividend history that's been pretty substantiated over many years, correct, Barry?
Yeah, over 150, in fact.
All right. So guaranteed investment, even if you're a high risk person, you can make a very strong argument that a portion of your assets should be in something that offers predictable growth.
And you're right on point there. Think of where most people are saving and investing money today. It's all unknown. It's usually in the market. We don't exactly know what a 401k or an IRA or a mutual fund is going to do. There's no guarantee in the market. This is a part of your portfolio that can allow you more predictability and certainty. And I promise you, if you have this in your portfolio, you're going to feel more peace of mind. We're not saying put all your money into high cash value whole life insurance, but we are saying some portion of your portfolio should be guaranteed, should be liquid, and it should be tax-free. Well, let's look at a real life example. Okay, this is a whole life illustration with one of the top 3 companies that we use. This company has been around for 176 years. I don't think they're going anywhere. And we're going to look at the guaranteed value. So as we sit in 2022, guarantees on life insurance contracts are 3%. That's a guaranteed contractual rate. It doesn't change. And there are some other factors that we get into, but I want you to see here on this particular individual, it's a 35-year-old. He's funding $25,000 a year. Now, you might say, I don't want to put $25,000 a year into a policy. I want to put $100,000 a year into a policy. Or you might want to say, no, I only want to put $5,000 a year into a policy. That's up to you. For our example today, we're using a 35-year-old male, preferred plus health, and $25,000 premium. When the $25,000 goes in a traditional whole life policy, Steve, $0 would be guaranteed, but we're not illustrating a traditional whole life policy. We've structured this policy focused on high cash value growth using a very unique rider called PUA, or paid up additions. So when that $25,000 goes in, what you see is that $19,300 of it is guaranteed, fully guaranteed. And every year thereafter, as the client gets older, the guarantees increase. And you had mentioned like the indexed life insurance products or the variable products. Those are not fully guaranteed products. Matter of fact, you see guarantees begin to erode in those types of products as someone gets older. But with whole life insurance, it doesn't matter. Someone in their 60s, 70s, 80s, look at this. Every single year.
Barry, let me mention one thing too. Sorry, I didn't mean to interrupt there. If people are new to this concept, the thing to probably understand out of the gate is you have fixed premiums and fixed costs with these policies, which is a huge difference, guys. You're not going to have the runaway costs with some of these other products, or the potential runaway costs, and that creates stability in your policy.
Yeah, and not only that, it's a hedge against inflation. Think about it. If you can pay $25,000 now and 20 years from now, it's the same $25,000, but it's going to feel like a lot less with inflation. And what's neat about this example is we're only showing him funding the $25,000 through the age of 65. Starting at age 66, he's not putting any more premium into this policy with the exception of the minimum, which is only $4,600 a year. But even at a $4,600 a year premium, the guaranteed cash value is growing by more than $25,000 a year, which is pretty cool to see. So guaranteed cash value in a whole life policy is always increasing. It's predictable, it's safe, and you don't have to worry about it. This is your sleep well at night investment, Steve.
Right. And guys, for those of you that are just getting into this, you've got there's a lot of design expertise that goes into what Barry's showing you. Your average life insurance agent is not going to have a clue of what happened to make this illustration possible. And it's a combination of factors that you guys need to understand. I guess at a minimum, just understand you're doing a base premium, you're doing paid up additions, and you're maximizing, to whatever percentage, you're maximizing your cash that can go into the policy in paid up additions and still call it life insurance. So that's really the beauty of what's going on here. And as long as you're within those life insurance limits, and we call them MEC limits, that you've got then the tax advantages that come along with life insurance. So that's really what you guys are looking at right now.
Yeah. Yeah, awesome. And we're seeing a few questions come in. I'll just answer one or two. The companies that we use both are direct and non-direct recognition. That's a question. What's a direct and non-direct recognition company? We would encourage you to go to InsuranceandEstates.com and read more about direct and non-direct. What I'll say about it in 10 seconds is at the end of the day, it doesn't really matter. If you understand how dividends are credited, I personally have policies with both types of companies. The way dividends are credited, it really doesn't matter. At the end of the day, we're only talking about pennies in difference on cash value growth. That shouldn't be your main reason for going with a company or for not going with a company. What's more important is the top company, the right company, and then how is the policy designed with the paid up additions rider, a term rider, and you want to maximize your cash value growth. And that was Penn Mutual. Someone had asked what company was that we were showing. It's Penn Mutual. They are one of our top companies.
Right. One of the things I appreciate about Barry, and we have such common ground on this, guys, is we're reviewing different companies every year. So we really want our clients to have the best company. It's not just the preferred company that we like to work with, which is pretty common in the industry. So just so you guys know, so yes, we're illustrating Penn. Penn's been very strong and currently is one of our preferred companies. There's maybe reasons why another company would be preferable, and that's something to know as you're working through your personal process.
Yeah, Penn Mutual isn't always the right company for everyone. We might use Mass Mutual, depending on funding or lump sums. Foresters Financial is another company we use, One America. We always make sure, as Steve said, we give you the best company for your goals. But there are 3 or 4 that we prefer to write with because of how aggressive they are in their cash value growth. All right, benefit number 2, Steve.
All right. Jump in. Legacy planning, one of my favorites.
This is right up your alley.
Yeah, there's a lot of buzz out there about life insurance. You guys may, if you're looking around, you might come across some people that are popular saying you should just buy term insurance. You should go ahead and put money in the markets. I have a very strong opinion about that as a planner. I've seen people that didn't have life insurance. I see a lot of people that their term expires. Maybe they have health problems by that time. And so this is permanent insurance. Get it. And if you can get it younger, that's ideal. I did see another question, is 74 years too old? Barry, you might want to speak to that. If they're in good health and are insurable, then it's certainly not too old, depending on your situation.
Yeah.
But legacy planning, leaving something for future generations, imparting assets as well as values. On the estate planning side, we work a lot with people's values, right? We look at educational instructions, trust planning, where we're leaving instructions for future generations. It's nice to pair that with some resources And that goes hand in hand with trust planning and these kind of things. And not to mention, guys, when you're doing life insurance, it's permanent life insurance, it's so preferable now with the tax laws the way they are. They've continued to erode retirement planning using IRAs and these kinds of things for beneficiaries who are not your spouse. You got a lot of red tape with that. It's just very messy. Life insurance is very strong because it just passes that death benefit to loved ones without taxes and without any restrictions around that. So for everything from your philosophical values, your spiritual values, to financial, this is a very powerful aspect of this strategy.
And I love permanent whole life insurance, Steve. I've done this, almost 22 years like you. And term insurance is not the tool to be using for legacy planning. Most people outlive their term insurance. As a matter of fact, less than 2% of term insurance policies ever pay a death benefit. So what that means is 98% of people that have term insurance are never going to use it. Now, I'm not saying it's a waste because you don't know when you're going to pass away. I have term insurance because I've got 5 children. But my point is, if you want legacy planning, don't do it with term insurance because chances are your death benefit is not going to be there. You're going to outlive your death benefit. So the great thing about whole life insurance is it doesn't matter if you pass away at 45 or 105. A death benefit will always be there. Now you can pass that tax-free to your beneficiaries. The one thing that I love about this also, besides legacy planning, is the death benefit is a permission slip, Steve, for people to spend and enjoy their own money. The number one fear of a retiree today is running out of money. So they might be millionaires, but they live like paupers because they don't want to outlive their money, or they do want to leave something to their beneficiaries. And so they don't want to spend everything they have. Well, think about it. If you had $1 million or $2 million whole life permanent death benefit, and you knew that was going to pass to your beneficiaries no matter when you passed away, you're going to have permission to spend and enjoy $1 million or $2 million of your own money. So that the permanent death benefit for legacy comes in and replaces what you could have spent. It really is a permission slip. It gives you that permission to spend and enjoy other assets.
And you also have, Barry, with the prediction you get for lifetime, you get your predictable growth, which also counters that fear-based, which is very prevalent when you have market-based investments, by the way, and that's all you have.
Yeah, that's right. That's exactly right. And who knows what those market-based investments are going to be, either when you retire or when you pass away.
Yep.
In this same example with our 35-year-old, $25,000 a year premium, now we're going to look at the death benefit. And what I want to point out in the right-hand column here is the first year death benefit is $674,000, and it does continue. But what is our 35-year-old client paying for? He's only paying for $304,000 of actual whole life insurance. We're stacking a term insurance rider on top of that eventually goes away, but he's only paying for $304,000 of whole life. Well, as time goes on, look how that death benefit continues to grow, and it's not growing from any out-of-pocket cost. It's growing because of what he's doing internally in the design of the policy with the PUA and the term rider. So let's assume that he funds the premium through the age of 65, like we showed, and then he reduces to the 4,600. If he passes away at age 90, his death benefit is 6.4 million, Steve. 6.4, and he only put in 866,000. I don't know of a better retirement plan, a better legacy plan than a high cash value whole life policy. I mean, this is remarkable to over time put in 866, and if he passed away, he could leave his family a tax-free $6.4 million.
It's powerful. This is an actual illustration guys. There's, this is where I get excited as well. We're all talking about things that we have experienced ourselves, just so you know, in terms of our appreciation of this asset. I think one of the things I'm passionate about is dispelling misnomers and things out there where there's inaccurate ideas about, this particular strategy. So yeah, this is exciting stuff.
If you only had term insurance, because this is what the financial pundits talk about, right? The financial entertainers out there, they talk about, hey, just buy term insurance and invest the difference. This isn't possible with term insurance. If you try to insure your life until you pass away with term insurance, you'll spend more money, you'll pay higher premiums buying term insurance. Matter of fact, whole life insurance is the least expensive form of insurance out there if you insure through your lifetime. Term insurance is the most expensive. A lot of people don't see it that way, but the older you get, your term costs are going up. So if you get a 30-year term policy at the age of 30, and then at the age of 61, you've got to renew your term, the premiums get astronomical. And then you've got to renew again around the age of 80 or 90. Again, one, you might not even be insurable, but the costs are very, very high, much higher than if you would have just insured your life with whole life insurance. We believe, go ahead, Steve.
Well, I was just going to say, it happens all the time, guys. It happened to my dad. He had a 20-year term. He's 75 now, and it expired. Do you think he went and just got some more life insurance at that point? Most of the time, people just let it go at that point. Even if they're in relatively good health, that age group is going to pay a lot for term at that point. So.
And Steve, you're an estate attorney. You've seen this over and over again with clients. How does it look with someone that has this in their life, in their portfolio, versus someone that doesn't have it in their portfolio?
What I've seen is that the people that get it and are committed to building up their policy over time, it's their favorite asset. The ones that maybe dabbled in it a little bit, maybe not so much, but the people that were committed to it, it becomes a very reliable aspect of their life, just the way it is.
Yeah, so. Absolutely. Well, let's shift. Look at just a couple questions here.
Yeah, I like an answer to somebody, let's see, I just happened to see in passing, there was one about, can you insure, if you're 74, can you insure your kids or grandkids? I thought that was a pretty good question, Barry.
Yeah. Sure can. There are a couple hurdles that we have to get over, but I've had a lot of clients do that. The parents have to have life insurance. So just know that going in. It doesn't matter if it's term insurance or whole life insurance, but if you want to insure grandchildren, you can own those policies. We just have to make sure that the parents do have life insurance coverage. And there are some limits and restrictions, but I've done that for a lot of clients throughout the country.
Yeah, we are recording this webinar, so you guys will be able to access that. Somebody asked about that.
Yeah.
Life insurance considered an asset when calculating death tax. That there are ways to create, a death benefit that's not calculated. But if you own the policy, it would be included, but it also provides liquidity. So it's very powerful. Even if it is included in your total estate, it's a liquid asset, where a lot of times that people own real estate and all kinds of other stuff, and they're not liquid enough to even pay their estate taxes. So people use life insurance in general and permanent life to create liquidity for the estate in terms of taxes. So that's what you need to be aware of. And if you have a business, if you own a lot of assets, it's especially important, critical to have some liquid death benefit to help with taxes and these kinds of things.
And today you would have to have an estate over 25 million to even have a tax issue.
You would, but everybody's watching the horizon on
yes,
that. Very,
true.
2026, all that stuff sunsets.
Yeah,
so we're gonna
expire.
Yep. So we're gonna see a tightening up of the exemption for federal estate tax. So.
And you bring up a good point. With the right trust, there are some ways to avoid tax. So that's your
Yep.
world. And
Yeah.
yeah,
And we're not giving legal advice. This is educational, just so
there
you
you
guys
go.
know.
That's right. That was the disclaimer. Okay, let's dive into benefit number 3.
All right. So capital preservation, we've touched on this a little bit so far.
Yeah.
Where do I put my money? That's the question. Barry, we've often talked about how if you lose 10% of your retirement account, it's going to take a lot longer to get that 10% back because you've lost your sort of your basis, I guess you'd say, at that point. So with the roller coaster of market-based investments, it's a wild ride. So obviously you're preserving capital when you put it into an asset that's going to consistently grow every year over its lifespan.
Yeah, you cannot have compound interest growth in a volatile investment. And you hear financial advisors talk about this often. Oh, you'll earn compound interest in the mutual funds or your IRA. No, you can't. The only way you get true compound interest is if you have a guarantee. There's no other way. You can't mathematically get there without a guarantee. So the point of, if you lose 10% in your market-based investment, you got to have a 12.5% rate of return just get back to get back to even. And if you lose 50%, you have to have 100% return just to get your money back. So when we talk about capital preservation, we're saying you could take market-based investments, roll those into a policy, and now preserve gains. So if you've done well with crypto or your mutual funds or your Vanguard index funds, and you want to preserve that and lock in that capital, you can move that money to a policy. There's some caveats, but you can move that money to a policy and now lock in those gains and get capital preservation. What I've done in our illustration now with our 35-year-old Steve, it's the same $25,000 a year premium, but he's sitting on $150,000 in market-based money, and he wants to get that money rolled into a policy. He's going to roll it over a 10-year time frame, which is $15,000 a year. So we take our 25 plus the 15 to give us now a $40,000 a year premium. And then starting year 11, the premium just reduces back down to 25. Now, this is one way to do it. Could he take the full 150,000 and put it into the policy year 1? Yes, that would be a large lump sum. We do it all the time, but I wanted to show you what would it look like if he did it over a 10-year time frame. And for all of you on the webinar today, you can choose whatever you want. If you want to do lump sums only in the first year, or you want to take 2 to 3 years to get that money into the policy, or 10, that's up to you. What I usually recommend is, if you want to do lump sums and you're taking that money out of the market or a qualified account where you might have a penalty or tax issues, is don't take out so much money that it's going to throw you into the next higher tax bracket. And we can look at that together. I'm not a CPA. I'm not giving you tax advice either, but there are ways to do it where you can still stay in a lower tax bracket. When this 40,000 goes in, we see now there's a lot more cash value, obviously, because he's putting more premium in. At the end of the 10 years, there's 478,000 in cash. Now you're going to notice too, where you're looking at the non-guaranteed values, and here's why. The companies that we work with, they've all paid dividends every year for over 145 years, not missing a single year in over 145 years. Some haven't missed even longer, but the companies we use, 145 years plus, have not missed paying a dividend. It's more accurate to look at the non-guaranteed values because of two things. Number one, the guaranteed values are already inside the non-guaranteed values. They're a part of this. But two, The reason the non-guaranteed values are more accurate is because the insurance companies we use have paid the dividends for so long. What we don't know is the amount of the dividend. So in year 5, is this company going to pay a $5,794 dividend? We don't know. It could be $5,900. It could be $5,400. We don't know. But all they do is they take today's dividend and project it forward. Like Steve said earlier, they're not doing a 10 or 20 or 30-year look back and calculating an average. They're just saying, what's our dividend today? And we're projecting it forward. And we believe these are very conservative numbers because we're in such a low interest rate environment. But non-guaranteed values are more important. And here's what's neat. Once his money rolls into this policy and the dividend is paid, it's locked in. It can never be taken from him or you. Once a dividend is paid, it's now new capital preservation. You're now earning true compounded interest on that, uninterrupted every year, because those dividends are locked in once they're paid.
Through compounding. And it's probably not too far-fetched to say, Barry, that if we're in an environment where rates are going up, that could positively impact dividend rates. That's been a observation.
Yeah.
And so we've been in such a low interest rate climate, guys, that when you're illustrating these, it's about as conservative as it gets. People have even asked, well, how do the mutuals handle the low interest rates? So they've weathered it pretty well. In a very low interest rate climate. So
they sure have. And you're correct. Historically speaking, as interest rates have gone up, so also have mutual insurance dividends. Okay, we'll just take a pause here and check any questions. See if there's anything appealing here.
Someone asked, Barry, if whole life is expensive when you're older. I think they're getting at that we're picking on term. So isn't whole life also expensive when you're 74?
It's going to be more expensive for sure. Yeah. But we would run the numbers to see if it works. And I often ask the question of someone older, is it more important for you to have higher cash value growth, or are you looking at this more for legacy and death benefit? Because if it's legacy and death benefit, it usually makes sense every time for someone older. But again, we've got to look at your health and what you got to prove for and how that health rating is going to impact the insurance cost. There's another question here, Steve, that I'd like to talk about, or at least answer, and that is, can people take the cash out? Are there surrender charges? There are no surrender charges in a whole life policy. An indexed universal life policy, if you put $25,000 into that in the first year, you have only a few $1,000s available because of surrender charges. There are no surrender charges in a whole life policy. And that's a really good segue, I think, for our benefit number 4, Steve.
Yes, sir. Banking and access to liquid cash. Liquidity is one of the, I think, especially for anybody that's owns a business, real estate investor, or simply someone that may want to purchase something in the future with liquidity. This is probably the most liquid asset that you can have. Think of it like maybe a piece of real estate with equity in it that you can also get a loan in a day or two, and you don't have to apply or do a credit check or anything like that. So if you're going to do policy loans, you can leverage that account with that liquidity, which is pretty powerful. And Barry, you may want to speak to this in terms of retirement planning or LIRP, life insurance retirement planning. You could have withdrawals of cash starting at a certain age and make that a tax advantage part of your retirement plan as well.
Yeah, for sure. This is one of the things that we are very pro about in regards to insurance and estates education, my company Focus Wealth Group, our education, infinite banking, how powerful these policies are when it comes to access to liquid cash. the ease of getting policy loans and using that money to invest in real estate or invest in your business or go out and invest in crypto or other assets that you want to own. The banking aspect is huge because, as Steve mentioned, when you take a policy loan, it's very easy to get money. There's no credit check, there's no application, and the insurance company doesn't question you, what do you need the money for? So back to our 35-year-old example, in any year, even year one, he could access up to 95% of the total cash value in any year. And so if we go to year 8, there's 358,000. So he could take a $300,000 loan and buy a real estate property if he wanted. A lot of people we work with, Steve, are business owners and they're leasing equipment. What I've told people, rather than paying the leasing company interest or a payment, why not take a policy loan, buy the equipment with cash from your policy loan, and now pay yourself back the interest instead of the leasing company. That's a much more advantageous move because if you look at the back end of a lease, you're probably getting charged anywhere from 9 to 15% interest. Well, what if you paid yourself 9 to 15% interest? That would be a way for you to capitalize and capture interest yourself rather than another financial institution. When you take a policy loan, the insurance companies that we use, they charge a 5% interest rate. But check this out. They do not physically remove the money from your cash value. And this is true whether you have a direct recognition company or a non-direct recognition company. So if he takes a loan for $300,000 in the 8th year, the full $358,000 is still earning interest and dividends in both types of companies that we've talked about. He's still growing money. He's still earning interest and dividends on the total 358, but he's able to use that 300,000 hopefully to buy another asset and grow even more wealth in that other asset. And he's still making money inside of the policy.
Right. So Barry, I'll jump in on that for a second. So those of you who are more risk takers out there, this strategy can be tailored to the level of risk that you're interested in. People also don't understand that. You know, that obviously if you have a cash account, you can take a policy loan and you could pursue other opportunities that you feel are more, have a higher return on investment. That's certainly something, if you're running a business, you can do that. The beauty of these loans too is they're very flexible in terms of how you pay them back. You know, you're not going to have to lock into a large payment every month, which is nice for business owners. Maybe you pay a good portion of it during your busy season. So it's just a very exciting option for business owners and real estate investors as well. In addition to probably most people that want a little liquidity to fall back on.
And there are some misconceptions out there, Steve, on the internet. You'll hear from some life insurance agents to take policy loans to buy your groceries and pay your utility bills. We don't adhere to that. We don't recommend that. What we recommend would be policy loans to buy assets, to grow wealth. That's the number one reason you take policy loans. Can you use it for an emergency savings? Yes. Can you use it to buy a car? Yes, but there's still a cost of money. We want to make sure primarily that you're taking policy loans to grow more wealth. Our goals for you are twofold. Number one, we want to help you create more wealth. And two, we want to help you pay the least amount of tax possible. And this policy does both of those things plus many more. Yeah. All right, let's look at any questions here relative to infinite banking.
I saw one, Barry, I wanted to circle back to one. This is a common misnomer. So somebody asked about cash value. You know, if you were to die, then do they take your cash value? That's a very common sort of idea. Do you want to address that, or do you want?
Yeah, no, that's a good point. Let's talk about it. Remember, in this illustration, the death benefit in year one is $1,025,000. But what did he pay for in whole life insurance? he only paid for $459. That's all he ever paid for out of pocket for the whole life insurance. So people will hear, or guys like Dave Ramsey say, hey, the life insurance company keeps all your cash value. Well, in a traditional whole life policy, that might be true, but in the type of policies that we design, it's very far from the truth. So what we do is we take the original $459 that was purchased, and if we add it to any cash value amounts, for example, year 11, if you passed away at 46 and you add the 450,000 to the roughly 30 here, let's call it 900 grand, your family would get $900,000 if what Dave said held true. Oh, the life insurance company keeps your cash value. I want both. Well, both would be about 900,000. But in the type of policy we design, your family would actually get 2.1 million. So what would you rather have them get? The whole life they paid for and the cash value, 900 grand, or would you rather have them get 2.1 million? See, these policies have a growing death benefit with no additional out-of-pocket cost. So your family would always get more in a properly structured, high cash value whole life policy.
Right. And I want to address one other quick question too, because somebody mentioned Dave. So you mentioned him, Barry. I don't think that he is aware of, and this is my best understanding and just my opinion, I don't think he's aware of this strategy. I think if as a real estate guru in his own right, I would think he would be more interested if he understood the design and what we're talking about. What Barry is getting at in the traditional is you're really only paying base premium for a death benefit. The cash value on that kind of a design is extremely slow. And it makes sense that then upon death that you get the death benefit, and whatever cash value was in the account was used to pay for that death benefit. It's kind of like when you die with a piece of real estate, you're not going to get the equity in the real estate, 100% of it, plus the value of the real estate. I mean, you are, but you're really getting the real estate at the end of the day. So, but anyway, so I think that that's what's going on with the questions about Dave and perhaps others.
Yeah, we want to be clear that you look at your own numbers. We can design policies for you, and you can see your own growing death benefit, your own growing cash value. We teach you how to use the policy, how to use it as your own bank and get all the benefits we're talking about. And I want to clarify, this will be kind of a good little slide to go through. Infinite banking, which we're very pro about, is a uniquely designed, properly structured, high cash value whole life policy. There are other advisors out there trying to do it with IUL or VUL, universal life products. It doesn't work, and it can't work because of the increasing costs and the market volatility in those types of policies. And we also have to have a mutual or fraternal insurance company, because when they pay dividends, those dividends come back to us as policy holders. They're in business to help us. We want the benefit of their profits. The goal in these infinite banking policies is we lower the death benefit on the whole life side as much as possible. That's why we're adding a term insurance rider. The term insurance rider lasts on the policy for a short amount of time, but it has a lower premium. We want high cash value. That's the goal. The goal is to minimize death benefit, maximize cash value, and you'll probably hear other names for it. Steve alluded to some of these. Bank on yourself, LIRP, LIRP, life insurance retirement plan, cash flow banking, the wealth maximization account, a 770 account that has to do with an IRS code, private family banking. At the end of the day, it's all infinite banking. Nelson Nash coined the phrase in the early 80s, wrote a book called Becoming Your Own Banker. What you've got to be careful of, though, is just because it's called something else doesn't mean that's what you're getting. So you've got to follow the criteria of whole life, properly structured policy, use an expert that knows what they're doing, because you will hear other names for it.
Yep. And we definitely have people that I've observed got the wrong policy, and they end up, maybe someone needs to fix it, so it's important to understand this. Another thing I want to say, Barry, too, about mutual companies, at owning a mutual whole life policy, the company is owned by the policyholders. It's a completely different deal than a stock company. I've actually had people from other countries say that these are outlawed, or they're not allowed in my country anymore, and they're bummed out about it for a good reason. The beauty of a mutual company is that they're going to do their best to return dividends, and those dividends are tax advantage because they're a return of overpaid premiums. And some people will, it's amazing to me, some people will say, oh, well, that's just a return of money. Well, actually, the company did a good job, right, at that point, and they're motivated to return some of that money in the form of dividends back to you as the owner of, part owner of that mutual company.
Yeah. And Steve, they did go invest the money. When I hear a comment like, oh, it's a return of premium, it sounds like they just put the money under a mattress and didn't do anything with it. No, they're making investments. They're making profits. They're getting returns on our money. So we like the definition of return of premium because that's the IRS definition, which keeps it tax-free. But in reality, we're getting profits because the insurance company did go make returns. They put our money to work.
You got it.
Yeah. Benefit number 5.
Well, we've talked a little bit about this. We got a little ahead of ourselves, but tax advantage, this is for retirement. And I touched on this, I think, as we were answering one of our questions. You can include this, when I can say that I've personally observed that the issues that people have, they get to a certain age, they have a large IRA or 401k. And one of their biggest concerns is, I have to start taking distributions and I'm going to get taxed out the wazoo because they're in a higher tax bracket and they don't want to take it, but they have to because they've hit that age. So the nice thing is to work in a component, at least of your retirement planning, to have something that's not going to create, additional tax liability.
Yeah, there's a theory, right, to be in a 0% tax bracket in retirement. It is possible, but for most people, it isn't, at least the way they're planning today. Because think about it. If you follow what the typical American does, you have a 401k, you have an IRA, you probably have a brokerage account, you're going to get Social Security, you might get a pension. Everything I just mentioned there is taxable. And not only that, the tax deferred accounts of 401ks, IRAs, any government qualified plan is tax deferred. It's not a tax savings. People say, oh, I'm saving on taxes. No, you're not. You're just kicking the tax can down the road. That's what you're doing. The government will get their money. Whether you like it or not, they are going to get their money. And if you defer money till retirement, it's 100% taxable in a 401k or IRA. And chances are you will pay more taxes on it then had you just paid taxes today, for several reasons. We won't get into everything, but we obviously looked at the US debt. And if taxes go up, you're going to pay more tax. But a lot of people in retirement, Steve, they don't have the write-offs that they have today that they would have in retirement, which could, again, propel them into a higher tax bracket.
Yep. And I think that was, you just made the point that I was thinking is just, using this planning to your advantage to have a liquid tax advantage retirement. And I was going to say that the Secure Act recently sort of rewrote the beneficiary IRA rules.
Yeah.
So they're always tightening up, guys. That what that basically did is it purported to maybe offer a few advantages, but it really cut back the amount of time that you could stretch out a beneficiary IRA. So like Barry said, the IRS is going to get their money. This is why they have MEC limits on life insurance as well, but it's still, we're still very exciting with what you can do. So, you got to realize that these other types of accounts can create complications in retirement.
And I want to emphasize that what we're going to look at right now, to me, and I've done this for 22 years, it's astounding. We're going to look at a real life illustration. We're going to look at retirement income that's coming completely tax-free. We're using the word tax advantaged on the screen, but if it's done correctly, it really is tax-free income. And there's three things you have to do to keep it tax-free. Number one, you must fund a policy with a premium at least 7 years. Longer is better, but the IRS guideline is 7 years. Two, you must keep the policy in force until you pass away. You can't cancel your whole life policy because then all your gains on your cash value become taxable. We don't want that. And then three, do not violate the MEC limit. Now, all those things we teach, we advocate, we help you with. When we design illustrations and I'm working with clients throughout the country, I'm making sure that we never MEC policy. But you've got to watch it too. You got to keep the policy in force. It doesn't mean you have to pay for it your entire life, but it is possible most of the time to get tax-free money. And that's what we're going to look at right now. And maybe before we get to the illustration, Steve, the Wall Street Journal, they call this the tax shelter of the rich. So do you think you should be having this in your portfolio? Do you think you would want this in your portfolio? If the Wall Street Journal says, hey, this is the tax shelter of the rich, it'd be like, well, where do I go? What is it? How do I get it? This is exactly what we're talking about today.
Right. And we've got some, the secrets of the wealthy, some of our materials that we've put together for you guys, touch on some of these things. And I think the common misunderstanding is, well, this is just for the wealthy then. Actually, in order to become wealthy, you got to follow what the wealthy does, right?
Yep.
So, or
What they do. That's right.
That's what we're talking about.
Yeah, you find success and then you follow those that have the success, mirror what they do. We're back to our 35-year-old, 40,000 a year example. And then starting year 11, he's going to reduce to 25,000. So follow me with this. There's going to be premium funded through the age of 65 at the 25,000 level. Starting age 66, he's going to reduce to the minimum of 7,000 for 2 years. Starting at age 68, Steve, he's done putting money in. Okay, no more premium, no more out-of-pocket money going into the policy. And at that point, we see our cumulative premium outlay of 914,000. And we see the premium outlay starting at age 68 is zero. Okay, no more money. He says, you know what? I want retirement money. I want tax-free money. I want to start taking out $160,000 a year completely tax-free. There's no IRS reporting. This doesn't show on your 1040 form. You don't have to tell your CPA about it, nothing. You just call the insurance company and say, hey, I want you to send me a check once a year for $160,000, and you can spend and enjoy that money any way you would like.
So Barry, we had a question pop up, Delsa, I think, and she said, is this a policy loan when you're withdrawing in retirement? I thought that was a good question.
Good question. Here's the general rule of thumb. Okay, this isn't true all the time, but the general rule of thumb is you first take out the money that you put in the form of a withdrawal. So he's going to take out up to 914,000 as a withdrawal, physically remove the money, because that's going to delay the time frame for the loans to start and then loan interest to accrue. He doesn't start taking loan money until age 73. So there is a loan balance, but in retirement, you don't pay loans back. The other rule of thumb is this: while you're working and you're using the policy for infinite banking as your own bank, and you're buying assets and you're buying real estate and you're investing in your business, etc., pay those loans back. Be an honest banker, pay the loans back. But once you get to retirement, you not only stop the premium payment, you don't pay the loans back. And those loans and any interest will simply be deducted from your death benefit upon your passing. So there's nothing to worry about once you get into retirement. What you do have to be smart about is the amount of money you take out. So I ran this at $160,000 a year through the age of 90. Well, what if he lives to 91? He's not going to have 160,000 that year. He would have some, but not 160. So what you do is you look at lifespan, family history, how, you got to make some type of projection as to how long you're going to live. So in this case, we have 5, 10, 15, 20, 23 years of income. Now, what blows me away about this, Steve, is the math. Remember, he's only put 914,000 in. And at that point, he's sitting on 2.4 million, almost tripled his money. Okay, almost. But he's able to pull out 160,000 over a 23-year time frame, which is 3.6 million. Well, how did he do that? If he only had 2.4, how can he pull out 3.6? It's because he only took out 160 a year. Steve, the remaining balance of the cash value, he was still earning interest every year. He was still earning dividends every year. And over the course of that 23 years through the age of 90, he pulls out 3.6 million tax-free. He put in 914,000. And if he passes away at the age of 90, guess what? He still gets to leave a $632,000 tax-free death benefit to his beneficiaries. Boom. I mean, is that not powerful? Who does not want that in their portfolio? That's a massive amount of tax-free retirement income.
Well, Barry, what is 160? If you were to look at it as taxable income, it'd be more like 200 or something.
Yeah, and it depends on your tax bracket, 200, 210, 220.
That's huge, guys. And Barry does a lot of that where he'll illustrate the numbers. So when you're talking tax-free income, it's actually, it's going to be, really more when you compare it to other investments that are taxed, right? So if you were doing a projection on your IRA or something, So very exciting. Leverage, liquidity, velocity of money. These are all terms that we want you guys to get familiar with. I think Barry just summed that up in that statement.
And you give us a good place to kind of have a wrap up and a synopsis of what we've talked about here, Steve. The top benefits of high cash value whole life insurance, and there are more. These are the top 5, but there are other benefits we haven't even gotten into today. In my 22 years, Steve, I've never seen a better investment, a better financial tool than high cash value whole life. It's why I personally own multiple policies, and I continue to add policies throughout my life. It's a guaranteed investment. Legacy planning. You have access to the liquid cash as your own bank. Tax advantaged, and in most cases, tax-free retirement income. Capital preservation, the benefits go on and on and on. We would encourage people to learn more. We're going to post into the chat and maybe even the Q&A a website that goes directly to Insurance and Estates, where you can click the link, fill out a little survey, a little questionnaire, and we're happy to meet with you to answer your questions, to run your own numbers. And look, I think I mentioned this earlier, Steve. I have clients all across the country. Some clients are putting in $500, $600, $700 a month. Some clients are putting in $200,000 a year. So what you land on is up to you. Depends on your health, depends on your age. We look at your income, what makes the most sense. But start now. Because I promise you, the sooner you start, the happier you'll be and the better future you'll have because of all the benefits you're seeing today. So take the next step, click the link. Let's see, we want to make sure it goes into the chat box.
I'm actually throwing it in here right now for you guys. All right.
Maybe put it, and then also put it in the Q&A if you can.
Yep.
So there it is in the chat box. And this is actually another webinar we did on this particular topic, the top 5. What you need to do once you're here on this site, is you schedule a conversation with me and then you fill out the questionnaire. This is your next step. We would invite you, take the next step, learn more, look at your own numbers, and really get these benefits in your own plan. Steve, any final thoughts?
No, I just, when you guys go to that link, you're going to come to the previous recorded webinar that we did on this topic. So you can review most everything. There'll be a few differences with that. We are also going to put a recorded version of this webinar up on our website, InsuranceandEstates.com. We'll have it under the webinars tab under resources. So you guys will be able to find it there. I'll probably also send it out to you guys again in a newsletter just to kind of give you the recorded version. If you want to go ahead and take next steps with Barry, I did put the link to that page. When you go to that page, you just need to click the red button to access Barry's questionnaire. And then once you complete that, you'll go to his calendar. So I invite you guys to do that. You can get some real life numbers for your situation. And I'm just excited. I appreciate all your questions. If we didn't get to your question, sorry for that. We kind of need to keep things moving. Don't want to keep you all day, but you can send emails with questions, and you can also get those questions answered, in a private conversation as well. So we invite you to do that. We want to support you as you're learning more and pursuing this fantastic strategy. So thank you, Barry, for all that you've talked about.
Yeah,
today.
my pleasure. And thanks for everyone for being on. We look forward to meeting with you. Be safe out there, be abundant in your thinking, and have a great rest of your week.
Thanks, guys.